Included in the packet this morning are comments on Vince Holdings, VNCE. We are raising our rating on Vince from market perform to outperform and establishing a $2.50 price target. Recall that the company in May 2nd provided their fourth quarter results and provided an outlook for the first quarter. In the first quarter, they had a fairly lackluster expectations, and recall that they also pulled their full year guidance. What happened yesterday was that they reported the first quarter. Results came in better than expected, better than their guidance. And in our view, the company is moving very quickly to mitigate tariff risks, much faster than expected. Their second quarter guidance actually was pretty good. It's showing underlying revenue strength, and in our view that the impact of the tariffs are going to be largely mitigated as they go through the balance of the year. We still have not provided full year guidance. We do believe that our expectations are relatively modest in thinking that most of our expectations have positive upside surprise potential through their mitigation of those tariff risks. Importantly, the company has moved their operations and sourced operations outside of China. Last year, China represented 80% of cost of goods. In the first quarter, it was about 66%. But by the end of the year, given that they have moved production outside of China to various Asian countries as well as Europe, that we believe that the company will bring down the cost of goods from China to about 25%. That's not the target. They actually believe that they will further reduce China's impact below that to 20%, maybe even into the teens. So bottom line is we think that they have moved very fast, faster than expected, to mitigate the risk from their exposure to China. And we think that our expectations have positive upside surprise potential in 2025. We did raise our expectations in 2025 from about 1.7 million to 3.1, but we believe that those estimates could be viewed as being conservative. We did lower our adjusted EBITDA estimate for 2026 from 18.8 to 12.9. I don't like the optics of that. My viewpoint here is that we are looking at the 2026 expectations as being conservative, especially should the economy start to show strength and we start to get Fed rate decreases. We do think that we could see some positive upside surprise potential with those expectations. Nonetheless, our valuation is based on 2026, and the stock is trading well below its peers. Its peer group is also depressed based on the tariff issues. And so we think that the stock is has been overly sold based on our 2026 more conservative expectations. The stock is trading at 4 times enterprise value to our full year fiscal 2026 adjusted EBITDA estimate. That's well below its peer group, which is trading near 6. And our viewpoint at 250, which is our price target, the multiple would be 5 times, still below the industry peers and still have some room for the upside. So bottom line here is we feel like things are moving in the right direction. The company is facing its challenges head on and much faster than expected. And fundamentals and underlying revenue strength looks more positive and constructive to us. And given the upside potential here, we think that there is a very favorable risk-reward relationship that warrants an outperform rating.